Right. It's my honor to welcome everybody to this event, Tearing Down the Pink Wall. I'm Henrik Cronqvist, and I'm the Dean of the Argyros School of Business and Economics at Chapman University. For those of you who are not local or regional, we are a mid-sized university in the heart of Orange County in Southern California. We have about 1,800 undergraduate students in our program, and we have more than 200 different master students in our programs, ranging from MBA students to Master of Science in Real Estate and Accounting students that are coming to our programs to learn about the topic of today, of course, finance, but a variety of other items as well. And we are thrilled to be part of helping out hosting today's virtual event. And of course, an event like this will not happen without hard work on behalf of my team here at Chapman. And I would like to recognize in particular Sarah Ramirez and Rita Desjardins, who's put in a lot of work to make everything go smoothly today. So I would like to hand over now to Angela Daly, who is the chairperson for WISE, which is Women Investing in Security and Education, to introduce the panelists. But before I do that, I would also like to recognize our two sponsors, and that would be Payden and Rygel, and also Ocean Heights Advisors. So Angela, over to you.
Thank you, Dean Henrik, for the great introduction and for being such a great partner to WISE. Hello, everyone. Good evening. Welcome. I'm Angela Daly, WISE CEO. With our virtual format, we're thrilled to have participants from all over the country. So if you're not a member of WISE, go to our website, sign up. The price is right. It is free. And you're going to hear about all of our fabulous events and have access to the great resources on our website. In 1997, a small but powerful group of women met in Orange County to put on an investment conference for women. They had no idea what to expect, but to their amazement, it was a stunning success. More than 500 registered, and they knew they were onto something. Fast forward 25 years later, and WISE has expanded, pivoted, grown, but remains true to its original mission of financial empowerment for females of all ages and all socioeconomic backgrounds. Every year, we reach thousands with our financial empowerment message. We work through community organizations such as Girl Scouts, Girls Inc., and universities such as Chapman. Tonight's event is part of our groundbreaking Tearing Down the Pink Wall series, which gathers the best and the brightest in finance to both educate us and inspire us and be role models. She can be what she can see. And that's exactly what we have tonight. Three fabulous participants, influencers in the world of finance. We have Sam Foster, Molly Murphy, and Natalie Trevithick. These women, fabulous women, are all part of a very elite group. According to Morningstar, only 11% of portfolio managers are female. And this number has stayed static for more than 10 years. And in fact, some studies show it's trending in the wrong way. You're going to hear from our panelists about their insights on investments and the career journeys that took them to the highest echelons in finance. And our hope is that some of you will consider careers in finance and help WISE spread the word of financial empowerment. Now, it is my great pleasure to introduce our moderator, Consuelo Mack. Consuelo has been a very important part of our Tearing Down the Pink Wall series since its inception more than a decade ago. She is one of the most admired and respected financial journalists in this country, a big proponent of diversity in the workplace, especially diversity in finance. She's a former anchor of CNBC and now has her own show on PBS, WealthTrack. One bit of housekeeping. Please put your questions in the Q&A box, not the chat box, and we will take them at the end. So with that, please join me in welcoming Consuelo and our panelists. Consuelo, showtime.
Thanks, Angela. You are the best. And I just want to say that this is the brainchild of you, Angela, and WISE, Tearing Down the Pink Wall. And it's just so exciting to be here. With Chapman and WISE sponsoring this, and also our fantastic panelists, these three powerful women in finance, and we need more of them. And it is, I mean, I come from a background in finance. It is an incredible profession. It's exciting, it's challenging, it's diverse. It's, there's never a dull moment. And as our panelists will tell us in just a few minutes, both personally and professionally, it can be very rewarding. So this is a two-part discussion. First of all, we're going to talk about the investment outlook, which, could take the entire session. But what's very important, we felt, to this audience was to discuss careers as well. And especially the MBAs in the audience who are, thinking about kind of what their next step is. Do they want to go into finance? What kind of finance? There are so many opportunities in this world, and our panelists represent many aspects of that. So, and then so we're going to have investment outlook. Then we're going to have careers, how they got to where they are now, and they're going to give you career advice as well, which is going to be very valuable. And then we're going to take questions from you, as Angela just said. So let me introduce our panelists. You've seen their bios, but I'm going to basically make it brief, but go over some of the highlights. And we're going in alphabetical order. So Samantha Foster first, Managing Director at Russell Investments, and she leads the firm's nonprofit practice, in which role that she's developing customized investment solutions for nonprofit boards and committees and staffs. Investment strategy, kind of the whole 9 yards, implementation, risk management, very important in the current macro environment. And also, she also focuses on operations and culture, which is something that is very important for those of us who have been in this business for a long time. Culture is really important, is where you go. 10 years managing total endowment asset allocation and risk for the University of Southern California. So she's done both private sector, where she is now, and also in the public sector. And it's important because I want you to understand as well in the career part of this, how their education factored into their success, how important that was, whether it mattered or not. And so Sam has a BS from Caltech, which she'll talk about, and also an MBA from Stanford. Next up is Molly Murphy. She's the Chief Investment Officer of the Orange County Employees Retirement System, OSERS, which I will, much easier to say it that way. Assets under management of $22 billion. She's been there since 2017. Prior to that, she was the CEO for many years at a nonprofit health system. She has also been in the private sector as a CIO at a boutique investment firm, and she's also done some trading in her time. And she is a graduate of Miami and Xavier Universities and a CFA, a charter holder. Again, these are important to consider in the career paths and how they got to where they've gotten. And finally, Natalie Trevithick. She's director and head of investment grade corporates at Payden and Rygel, which is a highly respected fixed income firm that was founded by a woman, Joan Payden, who still runs the place. She's an amazing pioneer as a woman in the fixed income space. And Natalie manages the firm's corporate bond portfolios in all of their forms. The fixed income markets are, incredibly diverse. And the corporate bond markets are the same. She spent 6 years at bond giant PIMCO in a similar capacity, and she was a sell-side trader at Barclays. And Natalie has a Bachelor of Commerce degree from Queen's University in Ontario and an MBA from the University of Texas. And I have to add one other thing, which I find incredible. She competes in the Ironman triathlons, the swimming, biking, and running, which is astonishing. But there's a competitive spirit among all three of our panelists. So we're going to go to the macro, the investment outlook, and investment strategy part of this now. And again, I'm going to go in alphabetical order. And my first question to each of our panelists is, just given the incredibly challenging macro climate that we find ourselves in, what are they and each of their firms and their colleagues and also their, clients, whomever they talk to, what are they focusing on? What are the two or three biggest macro themes that they're focusing on? So Sam, why don't you start out by answering that question?
Yeah, thanks, Consuelo. So at Russell, we work with clients of every size and type around the world. And so we really have a global view of what the current issues are in the market. But our number one concern remains liquidity. And that's an internal firm concern, and also what we hear from clients. And it really ranges from anything from having enough cash to pay your liabilities, whether you're a nonprofit and that's your spending payout, or if you have a liability, which is a capital call for a drawdown fund. So knowing where to source your liquidity, if you're going to take it from the fixed income market or from a public equity portfolio and a total portfolio solution approach, and where you have control of that liquidity, if it's in a custodial account or if it's in a money fund or if it's in a bank account. And really, no matter what your size, you're really worried about liquidity in these markets.
So Sam, can I ask you about that? Are you more worried about liquidity now, given what happened in the banking sector? Is this something that you're always worried about in the nonprofit sector, or is this something that is particularly acute now?
I think we particularly acute now, I think is a good phrase to use.
Mm-hmm.
But it really is something that nonprofits worry about all the time, because we tend to have more illiquid portfolios, and we do want to take advantage of an illiquidity premium. There's also very large, sophisticated investors. I'm sure Molly can agree that when you have larger portfolios that have illiquid investments in them, you want to get that return premium, that extra return premium from liquidity. And so knowing and being very precise about where you're sourcing liquidity from is very important, and what your next marginal trade is going to be. But in these markets, it's very important because you don't know where the next pocket of illiquidity is going to come from.
Molly, do you want to answer the question too? What's kind of uppermost on your minds with you and your colleagues?
Sure. Well, when you think of what a pension plan is, we're a multi-asset allocator. We are the asset owner, so we are the client to Wall Street, but we also invest for our members, our participants, and we need to make sure that their retirement is safe and secure. And so we sit in the middle of that. The questions that we are posing to Wall Street and we're trying to get a handle on from a portfolio perspective is about inflation, mm-hmm. how active the Federal Reserve will be, and will that result in a shallow or deep recession or short or long recession. So the depth of it and the duration of it, because we are not just one thing. We rotate sectors. So we have to decide when to play offense and when to play defense in each asset type. And so there'll be a plan of attack for a short, shallow recession, and there'll be a different playbook for a deep and long recession. And so that is one of the things that we are challenged with right now. If you ask me what I'm hearing from my membership, so Orange County Retirement System is an administrator of other organizations' pension plans. So we have about 24 employers, and about 12 of them are active, meaning they're still enrolling people into our pension plan. So if you wear a uniform and provide a service to the community in Orange County, you are most likely a member of our pension plan. So these are sanitation workers, bus drivers, police officers, firefighters, the court system, any county employee in any shape or form, the people that maintenance the cemetery districts, et cetera, et cetera. What they want to know, though, is my pension secure? And is it being eroded by inflation? So we are getting questions about the banking crisis. Has that, put my retirement at risk? We are getting conversations about what I would deem purchasing power of their retirement going through an inflationary period. So we have mechanisms in place to adjust to inflation and adjust to whatever the new interest rate environment is. A lot of people understand the Social Security system. We're very much the same as that. And so people that are retired are very, very interested in, are you going to give me an inflation adjustment or not? So there are a lot of things going on right now with respect to inflation and interest rates.
And actually, this plays into Natalie's strengths as well, because Natalie, you told me that basically one of the questions that you're asking yourself is the number one, is the Fed finished its rate hike cycle? which has been one of the most aggressive and the fastest in the Fed's history? And also, are they going to succeed in defeating inflation, bringing inflation down to their 2% target, which is a really ambitious one? So is that one of the major macro themes that you guys are talking about at Payden and Rygel?
Absolutely, Consuelo. And the answer seems to change by the day. But after the banking crisis, we really do feel that the Fed should be done with their hiking cycle. They probably should have paused last week. One thing they may be missing is the long-term lag effect of when these hikes took place and for us to be able to see the inflation data come down. We have had some shocks that inflation may be running still a little bit hotter than we would like, but we do think that that will moderate going forward. And our question is, has the Fed gone too far? And one of the implications of that may be what happened at Silicon Valley Bank, where it was the decline in prices of their long-term debt that really triggered the run on the bank. And just as Samantha was saying earlier, we're also focused on liquidity, not only of our bond portfolios, but also of the companies that we're investing in. And we're looking through to their balance sheets and how well could they withstand a recession. And the good news is a lot of these companies took the opportunity when debt was extremely cheap the past few years to refinance their bonds. So they don't really have this pending wall of maturities. So we actually think corporate America is pretty well positioned to weather, hopefully, what it will be a mild recession.
Let me ask the recession question as well to Sam and to Molly. So Sam, what is your outlook as far as your recession outlook is concerned?
I think moderately concerned about a recession. The really big question is, what will the Fed do in the next couple of meetings? The terminal rate that we had was a little bit higher than we think it is now. It was ending about 5%. But I think
this is the Fed funds rate.
It is
the short-term rate. Yep.
But I do think that it really depends. It's going to depend on the data, just like the Fed has said time and time again. And when we first went into COVID, I think there were so many questions about, is inflation going to be transitory? Is it going to be permanent? What's the state of affairs going to be going forward? How are supply shocks going to come out of the market? And really, there were just so many questions that time will tell. And I don't want to sound wishy-washy, but I do think that there's an element of this where there's so many pieces that are in flux. There's just an enormous amount of change that feels like it's coming through the markets. But knowing that there's a steady hand at the ship makes me feel better about that, recession or not.
So the confidence, the steady hand at the ship at the Fed,
yes,
that you think the Powell Fed is doing what they should be doing, yeah, basically, and they're not going to do anything radical. Molly, you mentioned it. It's something that your members ask: recession or no? How severe? How mild? What are your responses, or do you respond?
Well, if I were in the prediction business, I'd be a rich person and probably be retired on a beach. However, you can see the difference between where we are now and where we were in the last couple of recessions. Recessions usually need higher unemployment than we have right now. And so the main indicator that we're watching to make this prediction of, is it going to be short and shallow, or is it going to be longer, protracted, and deeper, really comes back to, okay, is the Fed going to raise interest rates to the point where we tip the employment to go the other directions? We're at all-time tights on employment in this country. And as long as people have a paycheck, they will continue to spend. And, inflation is a persistent state of increasing prices. And we really have to put that back in alignment in order for us to have a healthy economy. The Fed always targets 2%. We're more than double that now.
Right.
So, if they're going to be heavy-handed and push us towards 2% as their long-term target would imply, that will come with more layoffs and weaker employment situation, which I know a lot of people on this call in the audience are going to be looking for jobs. So hopefully the Fed will thread that needle. While their inflation targets have been 2-3% for many, many years, it doesn't mean that they have to get there in order to bring the economy out of its overheated state. So maybe, in the short term, I personally would like them to think about 3 to 4% and not necessarily push us all the way to 2 and let the economy grind down there naturally. But the employment picture is really resisting the Fed right now.
And Natalie, as far as let's talk about investment strategy. So, what is your outlook at this point for the fixed income markets, which is your specialty? And bonds had just a disastrous, the worst market in bond market history last year. And kind of what's the outlook for 2023?
Well, it's much more constructive now. So what last year did is it prepped us for a much better environment for bond investors, just given higher all-in yields. At the beginning of 2022, you were lucky to get maybe 2-3% investing in corporate bonds. This year, you could get over 4% just buying T-bills and over 5% investing in high-quality corporate bonds. And so we believe in 2023, bonds are going to do what bonds should do. They should produce positive returns and serve as an anchor to safety in a volatile environment. So we think investing in credit at 5% is a pretty safe risk-reward adjusted strategy for 2023.
And these are corporate bonds. And again, are you investment grade? Are you talking about, what about high yielding bonds, so-called junk bonds? What is your assessment of those segments of the fixed income markets, of the bond market?
I'm primarily talking about investment grade debt, but high yield debt is attractive too. That's at levels of 8 and 9%, but it's very bifurcated. So there are the companies which are in bigger trouble, which you could see an uptick in bankruptcies, but there's also the higher quality end of the high yield spectrum with yields at 8%, which we also find attractive, but we really have to rely on the fundamental credit analysis and not just chasing higher yields.
What are the risks that you're talking about at Payden and Rygel? What are the biggest risks that you see to the economy and the markets?
It's got to be the banking system right now. We aren't seeing stability there, even though, we've seen the equity market sell off. Bond spreads are also widening quite a bit, particularly in the regional banks, but even the major banks. So we don't think the Fed or the Treasury have done enough to really stabilize the markets, that there won't be further bank runs. So that's really what we're focusing on right now. We think the Fed has to instill more confidence in the markets to stop these bank outflows and give confidence back to the markets.
So how do they do that?
Well, we're looking for a total guarantee on all deposits. Now, the Fed doesn't have the ability to do it on its own. We'll need some congressional approval, but they could make stronger statements, and they seem to be edging that way. But until we get that, there is a little bit of a breakdown in the front end of fixed income markets, which we view as quite concerning.
Right. Sam, how concerned are you about the viability of the banking system?
I'm not. I think that is an existential threat that we should not be worried about. I'll go back to my steady hand comment. There will be bumps in the road, but it is not something that I think every investor should worry about because of the structure and regulatory environment that we have within this country.
Even though we've had some kind of, one-off failures, Silicon Valley Bank, for instance, I said one-off. Do you think it's basically a one-off that is not systemic? Is that what you're saying?
Yes, that's exactly what I would say.
Yeah. And investment strategy, Sam. So, what are you doing for your nonprofits in this environment? What are you advising that they do?
So I always advise that you stick to your asset allocation. There's never a time to be knee jerky. And when you have intergenerational wealth transfer that is very long-term investment horizon, you have an asset allocation, you stick to it, and you rebalance into markets that are down. And this is 100% the time to do that. So again, going back to the liquidity comments, thinking about where you can source your liquidity from and where your rebalancing you need to lean into. It could be something that you're to bring you up to one of your very long-term targets, or it could be something that's a little bit more tactical or strategic in nature. But I would say that every single portfolio has to have an allocation to core bonds, and there should be an allocation to U.S. Treasuries in that. And the range can be something short-term, like a 3-month to a 10-year, But in a nonprofit portfolio, matching your underlying payouts to having at least 1 or 2 years of liquidity is really important. And that guarantees the ability to make all of the payments out that you have, but also to use that as a structure for your drawdown funds in the private markets.
Are you talking about opportunities that these markets have created with your clients? And if so, what are they?
Yes. I mean, it really depends on the client, but there's so many different opportunities because some clients will want to rebalance. Some clients will want to have more liquidity and will want to put more money into the equity markets. Others may feel a little bit more cautious and will want to barbell their portfolio in terms of having much more in fixed income and more in private markets. So it really depends on the client.
Okay, and explain what barbell means in case our audience is not sure what you're talking about.
So in this case, it would be having a very liquid portion of your portfolio or your endowment on the short term and a long lockup for within private markets on the long side. And so you get sort of a blended liquidity sort of duration or weighted average liquidity of the portfolio, but you know sort of the order of operations of when to take $1 out of fixed income or the public markets and when to put it into the private markets.
Molly, opportunities and risks, basically for your pensioners.
Yeah, so we always subscribe to the best use of $1 kind of concept when we're thinking about pivoting the portfolio or what to invest in next. And again, it comes back to some modeling that we're doing on what should we be invested in if this is short and shallow, or what should we be investing in if this is long or deep or both. And so right now, if this is short and shallow, the most responsive securities are going to be your high yield bonds, and they're going to be venture capital and private equity in certain areas. So we are circling up some liquidity to be used in those ways in an opportunistic way. If we are modeling the long duration or deep scenario, we're looking at private credit strategies and we're looking at infrastructure because both of those can go up with interest rates if inflation remains persistent. They both have some characteristics that make them more viable in that environment. So we're actually being very judicious. We're staying near our targets on all of our asset allocations right now because we actually don't have that clear signal of go on either one of those scenarios yet. But those are the things that we're thinking about.
Because I was thinking, that's a tough balancing act between those two kind of extreme scenarios. So if you're running pensions, they're long term, but you still have your liabilities. You've got to pay people their pensions and everything else. So is it more challenging, this year? I mean, the last year than it's been for a while.
Well, the nice thing about pension plans is your outflows are very predictable. They're modeled by an actuary. So we know with absolute certainty how much money is going to go out to our pensioners every single month. And that is a set amount. We don't have to think beyond that. We don't have to worry about getting tapped for additional capital. Inside the portfolio, though, we do have capital calls that are being funded by our private credit managers or asked to be funded by our credit managers or our private equity. So we do have sort of that over under of about for us, it's about $40 million every month that could go out the door or might not go out the door. And so you always have to have that liquidity in your mind. Is it harder? The only thing that makes it harder is when you get asked for capital, when you would typically go to your bond portfolio. Last year, bonds were down so significantly, it was kind of a heartburn moment to go to that part of the portfolio for capital because you're going to lock in those losses. And typically bonds and stocks, they're counter to each other. One goes up, one goes down all the time.
Right.
And so when you have the equity drawdowns, you believe that you can go to your investment grade bonds and they'll be holding water for you. And that did not happen over the last 12 months. So it's been more of a heartburn moment, but we still have liquidity. We can still tap those markets. It's just you kind of have that gosh, I wish the market would have been nicer to me in this part of the portfolio. I expected my bonds to be ballast against my risk assets, and they weren't. And so you just have that moment of pause, like a little regret. You just wish you had had those historical correlations hold in 2022.
Right. I'm sure Natalie feels the same way in running fixed income portfolios. But Natalie, you just said you're more optimistic, that you think basically that the bond market is going to be, that it's attractive now, that you're going to get, absolute returns, right? So we should take heart that 2023 will be better.
Yes, from a total return perspective, absolutely. We should get positive returns from bonds this year. And it's a little bit of a win-win scenario in terms of if the Fed has been successful in fighting inflation and interest rates have to stay higher for longer. We're already at these elevated levels, so we shouldn't lose much more in terms of bond prices falling, and corporate spreads should stay relatively well balanced. On the other hand, if the Fed's gone too far and it turns out they do have to cut rates later on in the year, then that's going to cause yields to fall and bond prices to go up. So it will be a win for bond investors that way. So we're pretty confident that fixed income should do much better in the year ahead.
I'm going to ask the question that I usually ask everyone at the end of every wealth track, and that is if there's kind of one piece of advice to investors in this, very volatile and kind of highly charged market climate. What's your advice to investors? So Natalie, why don't you take that, and then I'll move on to Sam and Molly.
I'd say this is a year to not be chasing beta. So maybe stay away from some of those high risk investments. I do think having liquidity is key. I think some of the benefits of the public markets and corporate bonds is just the liquidity you can get, even if it's a little bit more struggled. I do worry about the private debt and equity markets because I don't think they've necessarily experienced the mark to market yet. So everything is good, until you get those capital calls. So I just like staying up in liquidity and being ready to either take up risk or take down risk in the year ahead as we get more certainty going forward.
Well, so listening to what you just said about private equity, and Molly, you had talked about looking at private equity, right? If in fact it's I can't remember which scenario, if it was the shallow recession or the severe recession. So Molly, do you want to pick up on that as far as the outlook for private equity, which is an illiquid investment?
So, institutional investors such as pension plans look at things very differently than a retail investor or an individual investor.
Okay.
We have different options available to us that the everyday person does not have. Private equity being one of them. Right. One of the reasons that pension plans like private equity is that the volatility of the valuations is lower than the public equity markets. It doesn't mean that those valuations won't get to the same levels as the public equity markets. They don't go as fast. And so we have a little bit more stability when we're in those markets against, the Russell 1000 or S&P 500 or just, XYZ stock. Mm-hmm. So we like them for that mechanism. They aren't without risk, and that's why only qualified investors over a certain asset amount can invest in them. So they are highly levered, typically. They have some unique characteristics, but the other thing is that they don't. When you see, I'll take the banking crisis for example. Credit Suisse and Deutsche Bank have been under fire for the last week, 10 days. Both of those banks have assets and equity value that was higher than their stock price at one point in time. It was a crisis of confidence. It wasn't that they did not have assets. And so those things can happen in the public equity markets. You don't see that in the private markets. So we do like that as a long-term investment in a pension plan. Now, the part that is interesting coming out of a recession, though, is the venture capital. Venture capital has a very distinct cycle coming out of a recession, what we call vintage years. The year 2023 is a vintage year. The assets that are put into the ground at the trough of an economic cycle for venture capital are usually the best years to invest. So it definitely is something that we are watching because we do want to put money in the ground in venture capital specifically, so that we can enjoy what is usually about a 10-year run on venture cycles.
So that's interesting. Just so that I understand, so the vintage year, so you think 2023 might be a vintage year for venture capital in that there aren't a lot of deals, or it's hard to get there for them to get financing, so it opens up opportunities to you guys?
It's all of that, because capital leaves, and then that void of capital is what you want to fill. And that will be the most generous year from a vintage year return standpoint, typically.
All right, that's really interesting. So what is your one piece of investment advice to individual investors? I know that's not your, that's not your sandbox, but nonetheless.
Right, but what I would say is I think that the revenge of the meme stocks was felt by a lot of people in 2022. The meme stocks were the darlings. Everyone, especially in their 20s, were all being told to go either buy crypto or buy meme stocks.
Right, GameStop or whatever.
Right, and the volatility of the normal market is more than most people can bear, which is why a lot of people are kind of licking their wounds when they look at their 401k statements, or they're looking at everything down 20%. But the meme stocks fall exponentially more. So the high highs come with really low lows. And so I would just caution people that that's really, that's a day trader mentality. It's not an investment mentality. And people that aren't watching end up the losers in that game.
Sam, your turn. Number one, do you want to comment on anything that Molly and Natalie have said so far? And what's your advice in these volatile markets, your advice to investors?
I completely agree with everything that Molly and Natalie have said.
That was not planned.
So I will comment on their comments. But I think my one piece of advice doesn't matter if you're a retail investor or if you're an institutional investor, you have to be able to sleep at night. And you have to be able to put your portfolio away and know how it's going to react, know what your plan is, know what you're going to do, and be comfortable with that. It's, a little bit of a life skill. But I think it's really important because it doesn't matter if you're looking at your 401k and making a plan for yourself, or if you're an institutional investor and you have allocated, part of your looking to other fiduciaries to manage your investment portfolio on your behalf. But the rationale and having that sense of calm will serve every investor over time.
So that's going to lead me to the one investment question. It sounds like it's the same question. It's not. Want a general investment advice for investors, individual investors. But now, if there's one investment that we should all own in our portfolios, in a long-term portfolio, retirement portfolio, what would it be? Sam, what would your recommendation be?
I think you have to have some combination of just public equities and U.S. Treasury bonds. It's, I think a 60-40 or a 70-30 or an 80-20 portfolio is that sort of spectrum of risk will serve different people, especially on the retail side. But knowing that you have broad depth across the market, but you have effectively the risk-free asset of our country will serve every retail investor well.
All right. Molly, what would your one investment be for a long-term diversified portfolio?
So this will be surprising for someone whose living is allocating actively, but I think for individual investors, your base should be a target date fund. It will give you access to all asset classes. It will mature as you mature through the different cycles of your life. And then you can do other stocks and other bonds around it. You can play with a portion, but I think having a base of a target date fund is a very sound way to build a portfolio.
Right, and all of the major firms have them, I might add. Yeah, it does all the work kind of for you in rebalancing everything else. All right, and Natalie, what's your one investment that we should all own some of in a long-term diversified portfolio?
On a similar theme, I think an S&P just index fund, you don't pay the management fees, but you can allocate a portion to individual stock that you find interesting or that you have the time to research, but really active management doesn't necessarily pay over the longer term. So, protecting your investment in an index fund, I think, is a very, safe way to go about it.
Stocks, not bonds? Natalie!
I'm not necessarily a believer that young people have to own bonds as part of their investment thesis.
Yeah, no, that's fair. All right, we're going to switch to, because I think we were kind of set up well by Sam in talking about life cycles and everything else earlier. So let's move to the career portion of this discussion, and that was a very interesting, about the investment outlook. There's so much going on, and again, part of this is to try to attract our audience to the financial services and everything that you all are dealing with on a daily basis. There's never a dull moment. It's a very exciting field to be in. So, Sam, let me ask you, as far as your education, and I mentioned, that you went to Caltech, and then you got a Stanford MBA. So, how important was your education, Sam, to your career path?
It was incredibly important. I am extraordinarily humbled and honored to have gone to both of the schools and to be an alumni for both of the institutions that I, got my degrees from. I think that going to Caltech, I when I was growing up, I was very quantitative. I still am. I love numbers and math, and I think that just was really who I was growing up. And then as I became a little bit older, maybe a little bit wiser, there was the yin to the yang that I thought I needed. And so I really wanted to go back and get a degree that would really complement my bachelor's degree. And so getting my MBA and was just really important to me, because I did get to learn about culture and organization and some of the softer skills that you need to run a business and be, an executive. And having those sort of formally taught in an academic setting was really important to me.
So that's, interesting. But did you, I'm trying to remember looking at your bio. So when you graduated from Stanford with your MBA, did you go right to an investment firm?
I did.
You did.
So I did. I went to, I worked at PAMCO. It was a fund of funds and fund of hedge funds. And we invested across every single type of hedge fund strategy there. And then after I worked at PAMCO, where I did investing and risk, I went to go work at USC, where I helped manage the endowment portfolio.
Right. And I might mention that PAMCO's founder, Jane Buchan, is a very active member of WISE. So it's terrific that you're here. So Molly, the importance of your education. You didn't get an MBA, right? But you are a CFA charter holder. But tell us about what impact, if any, that your education had on your career choices.
So I did get an MBA.
Oh, you did? I'm sorry,
yes,
I missed that.
That's okay. I kind of missed it too. It was a blur. But one thing that I would like to say is, so my education was great. I mean, I think I explored the social aspect maybe more than I should have. But at the end of the day, what it did for me is solidify my career choices, because I decided to become an investment person probably at the age of 9. I know that's kind of crazy, but there's a whole story behind it with my dad. And
no, what's the story? So there was a family influence, a strong family influence. In a nutshell, what was it?
So my dad was very cerebral. You were not going to play ball with my dad. You were going to sit quietly and debate a subject or read something and talk about it. So my dad was an attorney. but he specialized in tax law and estate planning. And so he worked with ultra high net worth families largely in the 70s and 80s when tax schemes were all the rage, before we had some tax reform. And so he was he was adjacent to the investment process, but he was always included because he had to be in the room with the families and their advisors to create these structures for them. And so my dad started every morning by reading the Wall Street Journal. And, I was looking for some way to bond with my dad. He was looking for something to do with me. And so we started reading the Wall Street Journal together and playing stock games. So we would have a bet on what a certain stock would be at the end of the year, or what the Dow Jones would be at the end of the year. And we did that for like 20 years. Wow. So I thought that was going to be my path from a very, very early age. So what college really did for me is when I got into my core investment classes, it was like confirmation that my true north was my path. I knew it from an early age, but it was still something that made me excited every day. So, but what I would say to people is, I went to 2 schools in the Midwest. I did not go to Ivy League schools. There is a fallacy that you need an Ivy League degree to do, top level investment. You might have to work harder for people to look at your resume. You might have to move. You might not be able to do it in every location. But one thing that I think Wall Street in general is learning is that diversity of thought is so valuable. If you have everyone with the same background and the same education, they will come to the same decisions. And so there are so many opportunities, and I'm just one example. But yeah, that's how I think about my college at this point.
Yeah. And you put in your 10,000 hours really early, no question about to your path to excellence thanks to your dad.
Yep.
Natalie, how important was your education to your career path and your career choices?
It was necessary, but I'm more about the destination rather than the journey. And I grew up in a lower middle income family. My dad was an electrician. He always kind of struggled. I want to make money. So I really looked at what would you get paid. I took an economics class in high school, and that kind of got me interested. So I got my Bachelor of Commerce at Queen's University in Canada. But then I went off and traveled for a year, and I came back and job prospects weren't great. So I kind of muddled around. And then I looked at it. I'm like, okay, I need an MBA. I want to work on Wall Street. I went to UT Austin, got the MBA. I kind of consider it an expensive 2-year vacation, but it's the education which opened the doors. You got to go to events like this. You got to mingle. You got to meet people. But one of the things I think young people miss is they aren't told how much professions pay. Like I looked at my friends going to get their history degrees or English majors, and you can become a teacher, but you also know how much you'll make for the rest of your life if you follow these certain courses. I really look for a career which, a ton of possibilities. You can go in so many directions, from bond trading to salespeople to product managers, account managers, which I really think has more of an unlimited earning potential set than other careers do.
So did you go right to Wall Street from Stanford?
Oh, I didn't go to Stanford. After I got my MBA at UT Austin.
Austin, that's what you just said. I'm sorry. Did you go right to Wall Street?
Sorry. Capital. Yeah, and it was exciting times. It was 2002, a sell-side trader on the trading floor. It was great.
So you went into trading. And again, was that a deliberate choice, or was that basically the opportunity that was afforded you?
It was a deliberate choice. I want to go into trading. Ending up in corporate bonds wasn't necessarily as deliberate, but
right.
I've been doing that for over 20 years now. I love my bonds now.
And why was, what did the trading aspect do for you as far as your career? How important was understanding the transactional side of the business?
I like that was related to what's going on in the world. So every day I walk, and even to this day, it's the headlines which are driving your behavior and what you're doing in your portfolios. And I never understood being an investment banker, because their whole job is trying to drum up new business, and they are like constantly have more and more work to do. Being a trader or even a portfolio manager, it's kind of like there's a trading day. That's not always when work stops and ends, but it's kind of a little bit more defined, and it's really market driven. And I find that, very exciting to this day.
Sam, let's switch to you. We're talk a little bit about some of the major turning points in your career, whether they were, negative successes, some of the setbacks, and that have made a difference, Sam, to your career along the way?
So I think there's been a few. I think deciding that I wanted to go work at USC was a big one. Prior to that, I had only worked in the public markets, really. I had, like the other two guests, I had worked at a mutual fund and did daily sort of pricing and trading and research. And at PAMCO, I had done the fund of funds with hedge funds. But USC was the first time I was really a long-term asset owner. And that gives a very differentiated view on how you look at investment managers and how you think about markets and the type of planning and really long-term view that you have to have, particularly for a pool of assets that really is infinite, horizon, and is meant to, stand the test of time. So I think that when I decided to go work for the endowment, I knew that I was going to learn about private markets. I knew that I was going to be able to, see how the university would issue bonds and, the different types of pools of capital that we had, to be a fiduciary for outside of the endowment. And I think that was really important. So making that decision was really big. And it gave me a very diverse set of markets that I could see. And it was great personally as well. I mean, I spent 10 years at USC, and I just think it expanded my horizons in ways that I hadn't anticipated.
Right. It's interesting that you're at Russell now, but you're advising endowments and so the nonprofits. Is there, as far as, I don't want to make too much of this, but do you feel like you've got a higher calling in advising nonprofits, or having worked at the endowment at USC? I mean, is that, and I know one of the things that you advise your clients on at Russell is culture. That was one of the things that was on your bio that I thought was so interesting. So can you tell us a little bit about that aspect?
I do. I think that every client and every organization really has its own culture, and knowing where to engage with a client within their organization, but also understanding the timing and the process that every organization is different. A family office is different than a small community foundation, and that's different than, a defined benefit plan, and that's different from a public plan. So, I mean, there's so many different organization structures, and knowing that one investment solution or a framework is not going to fit every type of client is really important. And you have to go in and you have to be, a friend and a colleague, but also a fiduciary to clients, because that is your role. And sometimes it's surprising how, a culture of risk management can really, sort of live through the whole organization, and that can be its strength. Whereas in another organization, they would really focus on, finding, really dedicated, specific managers, and that could be their strength. And knowing how to tie like an investment policy statement to those different organizations and their strengths is really important.
And so, Molly, successes, setbacks.
So I've had
major
a few
milestones.
I've had a few of everything. If you have a career that's long enough, it's going to zig and zag. What I would say is, whatever you have planned, count on it being different when you do the look back. For instance, I started off in fixed mutual fund sales, then fixed income sales, then I went to fixed income trading, then I ran a trading desk, then I went to PM or portfolio manager of bond mutual funds, then I went into separate account money management, then I launched my own firm and did that for a while. Then that got acquired and I became an allocator, and I have now allocated for insurance onshore and offshore in the Caymans. I have managed endowments, foundations, healthcare, defined contribution, defined benefit. And I've done that in the context of a corporation, a nonprofit, an asset manager, a public pension plan, pseudo government. So what I would say is the people that will have longevity in, money management especially, are the people that like solving puzzles, like to learn something new every day, and listen when the universe shows you something. So sometimes there's a situation that's challenging. Listen, learn, take responsibility for your actions, move forward. But then the universe also gives you gifts, and it'll give you something that is your next challenge. And you can see my career has zigged and zagged all over the place. But every challenge got me excited to go in on a Monday morning every day. So it won't look like you planned it, and it won't be a straight line, but it'll be so exciting, and it'll be fresh and new if you want to keep learning. So I'm still on the continuum. I laugh and say, I haven't managed a family office yet, so I have one more stop before I'm finished, which is kind of a joke, but you never know. The universe may present itself. But don't be afraid to change. Don't be afraid to grow. It's been an exciting several decades now.
No, it sounds like it has been. So Natalie, kind of successes, setbacks, circuitous route. What is the your career path? What are some of the lessons that you've learned along the way?
I think you have to be a go-getter. Like when I was looking for a job in finance, when I was still in college as a summer intern, back before the days of the internet, it was so easy. I actually looked in the phone book of all the financial firms in Toronto and mailed them letters to get called in for 2 interviews, and finally got a summer internship at one trading firm. It wasn't a glamorous job. It was just helping out around the office, but I went after what I wanted. Later on in my career, I realized that I'll say this, you can't predict the future, otherwise we'd all be rich and laying on the beach with Molly. But you have to have an opinion, and you have to say that opinion with confidence. So I learned, how to be engaging with people, also developing your social network. Most of my career progressions I got through referrals of people I work with or friends I knew. So it's really expanding your network, looking for opportunities such as this to bond with people. And people really do want to help people who've expressed an interest. So when people reach out to me and say, hey, I saw you on, Bloomberg, what do you think about this? Or I'm studying this. It's like you have to take that step forward and reach out to people to get what you want. And I also have to say, especially for women, it's trickier for us because I think men are given instant credibility and women have to earn that credibility. And I saw that a lot at some of my firms, particularly I'd say at PIMCO was a little bit more challenging, but you have to be able to speak up and, demand your space.
Right. I was going to ask you that, what difference does being a woman made to your career, positive or negative?
I'd say in some ways it's helped. Okay, we're still desperate to try to hire women, and the issue is not enough women want to go into finance. I think part of the reason is people don't realize the financial success you can get by choosing such a career. And, events like this are great to help educate women, but we just don't get the applications when we're actively looking for it and participating in other groups. I'd say it has been a little bit more struggling, not here at Payden. Payden's been wonderful, but at previous roles where sometimes, people think, oh, they only hired you because you're a woman, or they, unbeknownst to themselves, given that credibility issue, I think women are even taught to speak with more of a question mark in their voice. So when they're giving their ideas, they don't sound as committed as a guy who may not know what he's talking about, but says it with a little bit more confidence.
Mentors, have you had mentors along the way? And actually, I know that Angela did an interview recently for Tearing Down the Pink Wall for WISE with the woman who is in charge of the barons of the 100 most influential women in finance, and she was talking about the difference between mentorship or sponsorship and advocacy, that there is a difference. Have either one of those had roles in your career success?
Not meaningful roles. I don't have a mentor I could speak of. I have had sponsorship at my various positions. I'd say most of them have been men. So I know great stories there.
Yeah. But anyway, have they been important to you? And has someone, pushed you and or
Not
recommended
really.
you for a position? You've done it yourself, basically,
Not
right?
all myself. I'd say it's like a 5 out of 10. It's like been a bit of a help, but not.
Yeah.
Yeah.
Sam, I think same question to you. Basically, what difference has it made to you being a woman in finance?
Well, I think when I started my career journey, I thought I was going to be a scientist, and I'm pleasantly surprised now by the level and amount of women that are in science, and disappointed by the level and amount of and direction of women in finance and investing. I do think that, finance and investing is a fantastic career, especially if you're competitive and you like winning and you like having a voice and, being proactive. I think this is a fantastic career. And there's places not just within the portfolio management or deciding on investments, but, within marketing or sales or client relationships, and also the executive positions, within a firm that can also be very rewarding within finance and investing. So I think it's a great industry. And I do wish that more women and people of color, that there were that there is more diversity within finance and investing. I think for me, it's I want to think that it hasn't helped or hurt. It's probably hurt a little bit. I think definitely on the risk side, there's a lot more. There are definitely more men within those positions, and
you mean as far as risk managers are concerned, which is what
exactly.
one of the things that you do too.
Yep, yeah, exactly. I think there's just fewer women risk managers within the investing world for reasons I won't comment on. There's definitely more of a male bent to it. I think that that has traditionally been the case. I don't see a lot of changes there, but I do see that there are more changes within the investing side and the portfolio management side of women. Slowly but surely, things are changing, but I do think that there's pockets that there's not a lot of change at all.
Mentorship, somebody sponsoring you, advocating for you, what role have those played, if any, in your career?
I think I'll answer the same as Natalie. I think it's a 5 out of a 10. I think at different times there's been different people that have mentored and been sponsored, to me. I think as I try to pay that forward, I have taken a very strong role in some of the interns that I founded our internship program at the endowment. And so I think it's very important to continue to bring a diverse view and diverse people into the industry. So it's something that I keep in close contact with as well.
Right. And the internships, are you doing them at what level of educational level? Undergrad or high school? Or
they were undergrad, yeah.
Undergrad, yeah. Because again, WISE, which is, the whole point of women investing in security and education, is to empower women kind of all ages. They do it with, the Girl Scouts and they do it with older women as well. So it's just very interesting. Molly, what difference has it made to your career being a woman, if any?
So to date myself, I came into this business in the 1980s. There were no women really that I could have as a mentor because I was kind of one of one, when I was in my role. The other thing that was really challenging of that time, which I do think has abated to a degree, is that the men that would have helped were also held back because they were encouraged not to help the women at that time. Because the men in leadership didn't even want them there in the first place. So why help them become successful? We'd rather have them fail and leave, was kind of the mentality when I was first starting out. So
how did you overcome that?
Well, if you've met me, I'm the most tenacious person you're ever going to find. You tell me I can't do something, you just like lit a fire. So, I mean, I had people purposely try to, silence me, sabotage me, make me cry in public. I'm like, I don't do that anyway. So why would I do that here? But at the time, you have to think about how can you thrive and be successful without a mentor? And so, to your original question about sort of advocacy,
Right.
What is a mentor there for? Yes, they can help you open doors. They can also help you recognize a skill deficiency that you might go fix, and they can give you suggestions on how to do that. But you can also do that by just emulating people who are successful. You can look at Warren Buffett and take away things that he does well. You can look at Jamie Dimon and think about how does he run his organization. You can listen to speeches. They're unisex in that way. You don't need to have a mentor because you're a female. You don't need to have a mentor that is a female. But what I can say, you will not be successful without an advocate, because everything that happens in your earliest days, and even as you become more senior, happens away from you oftentimes.
Mm-hmm.
The decisions on who gets promoted happen in a room in which you're not present. When bonuses are given, oftentimes you might not be present. When partnerships, if you're in a partnership model, that is also decided within a group of people and you're not one of them. So you really do need to understand who will be an advocate for you in those rooms, because that's where career decisions get made. I've always figured out who saw my work as valuable and saw my effort as valuable and tried to build relationships with those type of people, because I knew that I needed someone who would speak on my behalf in those rooms. So I think a combination of just picking out people in the industry who had qualities that I thought were good leadership qualities or business qualities or investor qualities, and then having an advocate is very, very powerful.
So interesting. Sam, as far as, let's forget what difference is it being made, has it made being a woman question, but, let's toot your own horns here. Why do you think you've been as successful as you have been? Sam,
I'm so bad at tooting my own horn.
Well, this is your opportunity, and you're going to have to speak out. Take Natalie's word and just, no questions, just firm declarative sentences. This is why I think I've been as successful as I've been.
I'm very competitive. I'm very tenacious. And I like solving problems. And I think there's a balance that I have that is very quantitative, but also very qualitative. One of the best comments I ever got from a partner at a firm was, he said that for as book smart as I am, I'm actually more street smart. And I think that sort of nails my thought process and the way that I go about, myself.
And were those innate, or did you acquire them? Did you, deliberately decided to be street savvy and book smart and math smart? Was that a goal of yours, an objective?
I don't know that I ever had being book smart or street smart as an objective.
Yeah.
But I think they're natural qualities, and that I've tried to cultivate them over time. As Molly was just saying, to be able to pick out people and learn from them, even if they're not close to you, I think is a very important skill. Like, how do you teach yourself new things? Mm-hmm. And you can be very self-reflective, even from afar, by looking at what other people are doing. And I do that a lot.
Natalie, why do you think you've been as successful as you have been?
I think one of it is just being able to make decisions with imperfect information. So I feel I'm a pretty quick decision maker, and not being too emotional about it. Because sometimes, you got to buy bonds or sell bonds at a loss, and you can't be too attached to them. So I think that's really helped a lot. I like one of the Facebook sayings, I think, was that done is better than perfect. And I'm a big believer in getting things done and just do it, and as opposed to trying to get everything perfect.
Right. Perfection is the enemy of, perfection is the enemy of the good. But again, this ability to make quick decisions, to have the confidence to make these decisions, how did you develop that quality, that characteristic?
Part of it is always I've been a little bit aggressive, but also observing other people and seeing what works. When I'm like in a meeting and I'm like, oh, this person has this saying, or they do this, and I say both a benefit and a negative for my personality is I'm pretty blunt and I don't take a lot of yes. Sometimes I'm a little bit scary to people, but I don't mind that, to have that. I won't say intimidation factor, but a little bit of that. So I feel like I own my space pretty well.
And that can be off-putting in a corporate setting frequently, but
it can be. It can be both. I'm trying to soften my edges. That was my PIMCO edge, so it took me a while to adjust to the more nicer Payden culture. It's a work in progress. It's been 11 years. I'm still adapting.
No, at any rate, yeah, I know the PIMCO culture relatively well. In the old days, at any rate. So, Molly, you just described some of the characteristics of the reasons why you have been successful as well. So do you want to elaborate a little bit and make sure that we actually covered what your characteristics are that have made you as successful as you've been?
Yeah, I mean, I think it gets summed up with like grit and determination. Mm-hmm. And so when I'm talking to people, because now I'm a mentor, who would have thought? I mean, if you saw the silly mistakes I made over the years, you might question your thought process on that. But, there are a lot of TED Talks on the value of grit. So I would highly encourage people to just kind of Google that and listen to some of that. That's really valuable. But I try to tell people that every person has a superpower, and everyone will be successful when their superpower aligns with the culture of the organization where they work, so that they can bring their best to a place that wants their best and uses their best to its full potential. And so like my superpowers, I think I have two. I mean, I should only have one, but I think the first superpower is that I am very decisive. And if you ask me, how did I get that? I got that out of the womb. So I can't tell people how to become more decisive. I just am that way. I too had to soften it up because decisive women frighten people. And so you do have to learn how to use that superpower judiciously. I can usually sit with a person and understand, should I communicate through a chart or through a table? Should I communicate in a long form or bullet points? Should I communicate with this person by telling anecdotes and stories and using simple language, or should I get very deep and technical? I'm able to communicate complex ideas in simple ways, or I can take something very simple and overcomplicate it if somebody wants to hear it that way. So I think my communication style married with my decisiveness has led me to like the CIO skill set. So I think if you come back and you sit with yourself and you decide, like, what do I do really well? And where do I have that confidence center? And you can go and find an organization that uses you in that way. I think that you'll be ultimately successful.
Wow, that's very valuable. Now we're getting to the point where we're going to go and open it up to questions from the audience. But Nella, let me, who's going to be fielding these questions at any rate, let me ask you each one more question before we go to the audience. So forgive me, audience, for hogging the time here. So if there's only one piece of career advice that you would give to our audience, what would it be? And Sam, why don't I start with you?
The best piece of career advice I ever got was an annual hold 'em or fold 'em. And I got that from a boss that had hired me, and I was currently employed by that boss. So her piece of advice was, every year you have to decide if you want to stay at the firm that you're at and keep doing what you're doing, or if you want to try something else, try something different. And that will really shape, it'll give you a sense of what's out there that you might be missing, but it'll also recommit you to where you are. I think that was great advice.
So every year, so you do that, you've got a process to do that for yourself?
Yes.
And so far you're staying at Russell.
Yes.
Let your current firm listening, I'm sure they'll listen to this very carefully. All right. Natalie, what would yours be?
It would be a don't settle, don't do something you hate, but be realistic about what you are willing to do, how many hours you want to work. You know, a lot of these jobs are pretty intense in the financial industry in the beginning, and you have to know you'll put in the hours. There's a lot of talk about quiet quitting out there, but you know, that's not really going to get you ahead in your business. So be realistic about your goals and what you want. And I totally agree with Sam about, I don't know about reevaluating every year, but people tend to get the biggest jumps in their pay and promotions when they leave a firm. So you have to be careful about not staying in one place too long just because you're comfortable early on in your career, but you also don't want to be a job hopper.
And you know, the financial services, well, especially the area of finance that you all are in, are very demanding. So you know, have you worked out the kind of the work-life balance? Have you decided that you're going to be all in what you're doing, or have you reassessed that?
It's definitely changed. When I was at PIMCO during the financial crisis, we had to be at work before 4 a.m. That wasn't sustainable, you know? So it's something I did for I was there for 6 years total, only before 4 a.m. for about a year or two, but the regular time was 4:30, so it wasn't that different. But now, Payden, there's much better. I do think I found balance here.
Right.
We don't have to work weekends.
That's a positive, no question. Yeah. Molly, the one piece of career advice that you would leave for our audience before we go to their questions?
Yeah, so I'm going to tag on to my other panelists. When you're considering making a job change, I've been a hiring manager for almost 30 years, and I consistently see differences between male candidates and female candidates. Male candidates will apply for a job if they know half of that job, if they have half the skills. Women will only apply for a job if they can tick off every single box on the skills needed for that job. And one, you're leaving a lot of opportunities off your list if that's what you're doing. And two, when you get to that new job, you will already know everything. You will be bored. So I just tell people, whenever you're thinking about taking a job, you should know only 50 to 60% of that job. And you should learn on the job so that you're engaged and you're excited. And it opens so many more opportunities for women, especially if they take that perfection mindset out of their career path.
Really great advice from all of you. So Nella, it's your turn to ask the questions from the audience.
Yeah, let me just go to that. I have to say I got so much out of this information that each of the panelists shared. There was some great advice there. Didn't get very many questions, a couple of very nice comments from people who were listening. And the only question that came up was at the beginning, and I think it got answered, but I will surface it just in case there's something to add on. And it was somebody asking, what advice would you give to a student who is inspired about possibly having a financial career, but doesn't really have the background or know what that would be? I mean, I don't know if it's a graduate student, if it's a specialized designation, or what should somebody do to get interested, internships, things like that. So if any of you would like to give that a shot, that's literally the only question that popped up. So if anyone else has questions, please put them through in the Q&A. But I may go back with a couple of comments that you guys made that I thought were terrific. So,
all right. Well, believe me, I've got a couple more questions.
Great.
No question. But first, that individual who wants to take that as far as your advice.
I'll start. I'd say if you're interested in it, then you should learn about it. So even if you haven't taken an actual class, you can read the newspapers, listen to TED Talks, inform yourself so you can have an intelligent conversation, and go to some of the company events that I'm sure you have on campus, which could introduce you to corporations, and you can learn more about what these jobs entail.
Good comment.
Anyone else want to take that? Natalie or Molly? So, all right. So here's my question for you. What motivates each of you the most professionally now? So Natalie, do you want to start with that since you just answered the other question?
Is it wrong if I say money? but it's also
No.
making money for our clients. Like, I love it. It's the competitive nature in me. I'm always looking. Most of my accounts are relative to a benchmark. So I'm like, how are we doing relative to the index? Where did we go wrong? Where did we do right? How can we tweak our strategy? How can we make this better? How is this going to adapt? Running scenario analysis, So I love looking at performance numbers. So that's always exciting.
Okay. I'm thinking when you said you weren't working on weekends anymore. No, you're just doing the Ironman.
I will say one thing about
you're
that.
filling your time.
I started those when I was at PIMCO, because when I'm like, when you're exercising for like 12 hours all day from like 6 a.m. to after 6 at night on the weekend, you're like, work's not so bad. There's air conditioning and seats and food and, it makes you appreciate work.
Right. So, Sam, what motivates you the most professionally now?
I think, I love knowing that I'm doing a good job. And that could be being a fiduciary. It could be helping a client solve a problem. It could be generating, a high return with low risk. There's just a bunch of different ways that I enjoy, working with other people, and that make me feel really good.
Right. Molly, same question to you. What motivates you the most professionally right now?
So, I've had a varied career. I've worked for some very aggressive places. The pay is fine. There's work-life balance. If anybody does want work-life balance, I think they should think about public pension plans. You get to see a lot. You get to be an important investor, and the work week is pretty manageable. I mean, obviously, if we have a banking crisis over the weekend, you're attached to your cell phone, but you can work a 40 to 45 hour work week and go home and see your kids. So, but what makes me excited, I am so passionate about the people that do the jobs that most people don't want, being able to retire with dignity. And so, being able to say to a person that put their life on the line as a police officer or a firefighter, which if you live in California, God bless the firefighters here, that they can retire when their back gives out or when their knees give out, and they don't have to fear that their home's going to be taken away, or they're going to have to downsize into a 1-bedroom apartment and live on food stamps. Public pensions allow people that dignity. And I just am very passionate that not only do we serve 50,000 members, but we make sure their families are taken care of, because that paycheck goes to their families, and then they spend it in the community. They spend it in small businesses around Orange County, and it fills the coffers multiple times over inside the community. So we are one of the biggest payrolls going out into the community every single month. Our payroll is $120 million that we put into Orange County. And so I'm really proud that people that work so hard get to make their life decisions at the end without as much stress as they could otherwise.
Very inspiring. And I believe that money management can be a calling and for all of you as well, because your clients really depend upon the job that you do. So I think it can be a higher calling without any question. Just what Nella said, what a wonderful discussion we've had, and I've learned so much. So thank you, the three of you, so much for giving us, career advice and also perspective on what's going on in the markets. It's really been terrific, and I can see why the three of you are as successful as you are. So Molly Murphy and Natalie Trevithick and Sam Foster, thanks so much for joining us today. And I'm going to turn it back to Angela. But thanks for all your time.
I want to thank all of our panelists. It was a terrific discussion. The investment part was fascinating, and the career part, very, very interesting as always. So thanks to all of you. Thank you to Consuelo. Thanks for everyone for joining us, all of the participants here. And I have to thank the WISE team that put this together, the Chapman team that put it together. Yeah. So please take a look for our next event, which will be at the end of May. And it's going to be a wealth building tips. So as I said, sign up and you will hear all about our events going forward.
Thanks, Angela.
Thank you. Thank you all.